Good afternoon, everyone. Thank you for joining us today. For those of us that are here in the room, we're going to go live at exactly 4:30 p.m. So before we do, I'd like to just give you some indications in terms of the evacuation procedure. In the unlikely event of an emergency, we're going to exit through any one of the 3 emergency exits. The first is to the left behind me, another one is to my right, and the third one is through the main entrance. We will then meet at the assembly point, which is located to the left of the main gate. There will, of course, be a team on standby to assist you. There are some restrooms which are located in the foyer and the left. Please note that no smoking is allowed in this building. Thank you. All right. Good afternoon, everyone. Welcome to all of our guests that have joined us in person as well as online on our virtual platforms. Thank you for joining us today for the second edition of the 2023 Monetary Policy Review. My name is Tulisile Khadebe. I'm an economist within the Economic Research Department, and I will be the program director for today. We're delighted to have many of you here in person with us. At the SARB, we are always happy to engage with you. We publish a monetary policy review twice a year where we discuss the domestic and international developments that affect the monetary policy stance. We'll begin with some brief remarks by the Governor, which will then be followed by a presentation by our Chief Economist, Chris Lowald. We will open up then for Q&A. Please remember to take a copy of the NPR once we leave. I'll now hand over to the Governor of the South African Reserve Bank, Lesetja Kganyago.
Good afternoon, and thanks, Tuli. It's a great honor to welcome you to the second National Monetary Policy Forum for this year. Feels like just yesterday when we gathered here 6 months ago. At the time, we noted that the supply side shocks that fueled post-pandemic inflation were slowly dissipating. In the same breath, however, we were cautious that policymakers globally still had to manage the complexities brought about by high and persistent inflation and lower economic growth. As it turns out, inflation had been more persistent than initially thought, prompting central banks to say that they are going to keep policy tight for longer. But what we have seen recently had been that headline inflation had continued to decelerate, but remains well above desired levels, requiring many advanced economy central banks to continue to consider even raising rates further. Meanwhile, world growth has been staggering along. The battle against inflation is far from being won, both here at home and globally, which we discuss in some detail in this edition of the Monetary Policy Review. As the Monetary Policy Committee, we remain steadfast in our commitment to price stability and the necessary policy actions required to anchor inflation and inflation expectations sustainably around the midpoint of the target band. Chris has got a longish kind of presentation, and I'm going to invite him to walk you through the presentation and hope that it doesn't take as long as I do.
Thank you very much, Governor. Sometimes I get told I should be really quick, and sometimes I get told I should drag it out, so it sort of depends on how bad the news is, I suppose. I do have quite a lot of slides, unfortunately, but I will go through them quite quickly, as I often do, and just try to highlight in some of the charts particular things that I'd like you to take away. Before I start, let me just thank Witness Sambana-Gavi, who runs the team in the department that puts together the MPR. So there's a core group of people that work on it, and then they pull in inputs from many other departments and other parts of our own department. And it's a lot of work, and we're very appreciative of how this all gets put together, and it's a great product. So I, as always, urge you to read it. This time around, we did a range of boxes on particular topics that I think you'd find pretty interesting. Okay, now if I can figure out how all this works. Here we go. So the title for this NPR is A Bumpy Road to Target. I want to talk through just the overview quickly of the kinds of things that I'm going to show you in more detail. The first point is just simply that the global headline inflation is lower, but core is looking more persistent. And there's a lot less certainty about the trajectory for core inflation. We'll talk a bit more about that. Global GDP is turning out to be on the resilient side, but there's quite a lot of divergence between countries and several different sources of shocks to GDP growth that we'll talk about. South Africa's growth performance is better, but it's starting from a point where there are very low expectations from the kinds of constraints that we've all been obsessing over for quite some time now. There's likely to be a slower return to global policy targets, the inflation target, and the big question that we spent some time last week in Morocco talking to people about was whether this means that G3 interest rates are going to be high for long or higher for longer. I'm not going to answer that question. I don't think we can, but that's the nature of the debate out there, and it's worth noting. All of this is feeding into an environment for emerging markets, which is pretty difficult, and I've tried to capture it by making the point that there's obviously more debt out there. That debt stock isn't going to go down, and I'll show you why. There are fewer capital flows that are likely to come to emerging markets given the global environment we're in, and there's likely to be less cooperation in how we solve some of these problems, and that will prove to be its own challenge. Again, for emerging markets, on balance, currencies are going to be weaker, and as those macro imbalances that they face don't go away very quickly. For South Africa specifically, headline is likely to remain, at least for the foreseeable future, above the midpoint before going back to the forecast target range. I'll show you how the time frames that that's going to happen on, and core remains volatile. So in sum, whether you're looking at this from a global point of view or a domestic point of view, it's hard to see a very smooth transition back to the inflation target. So this first graph starts with what global inflation looks like. You can see that it remains quite elevated, even though that blue line has come down quite sharply. It's sitting at around 6 to 7%, and those red dots show you what the IMF's annual forecasts for 2023 and 2024 actually are. The key point to take away simply is that that final red dot on the right-hand side is not coming down to that 2% much lower level that you see on the left-hand side of the chart. What's going on out there? Well, there are things like food price inflation, which are going down. There's oil prices that are going down, but they've started to pick back up again, and you can see that in the far right-hand side of that chart. So we've had negative contributions from things like oil prices and food prices to global inflation, but they're starting to pick back up again, and that's quite worrying. Part of that's simply base effects that are fading, but part of it's also new shocks that are emerging to these particular components of global inflation. If we look at the core inflation measures, again, the same kind of story here. Like headline, core inflation is easing across many emerging markets. That's what I'm showing you in the left-hand graph. And on the right-hand graph, you also see core inflation, but this is for advanced economies. And again, there's a little bit of easing here. There's less easing, much less easing happening on the core inflation side for advanced economies than it is for emerging economies, which is a bigger concern. In part, this has to do with the way in which emerging economies have reacted to their inflation problems, but it leaves us in a position where those core inflation measures are likely, again, to stay higher for longer, complicating the future trajectory for inflation. Part of the advanced economy core inflation story has to do with services. Again, those of you who read the Financial Times or read the IMF, the World Bank's work, you will know that this is part of the big story going on out there. I'm just trying to show you a little bit what this actually looks like. The left-hand graph shows you services inflation for the US, the Eurozone, and the UK is in red. Eurozone is green, US is blue. And you can see those services inflation measures are all quite high. Much of that is driven by rental inflation, and that's what I'm showing you in the right-hand graph. The middle graph. And then the right-hand graph, we differentiate here between the US and the UK. And you can see in the US inflation measure just how strong that housing and rental inflation contribution to services has been. So if you strip it out, you get non-housing services inflation coming down in the US very strongly, but not at all in the UK. In fact, quite the reverse, it seems to continue to rise. So the upshot of all of this is that for advanced economies, there are a few different things going on, but all of them are difficult and not likely to generate very strong declines in services inflation. If I were to show you labor market measures, you'd see that some of the US core inflation measures are being driven by other things than housing. So what's going on in advanced economies and emerging economies as well, but less so there? One of the problems is that demand still remains very strong. Household savings buffers are very high. If you look at the left-hand graph, you can see the blue columns are the household savings buffers as a percentage of disposable income for the UK, Japan, US, and the Eurozone. And you can see these numbers are really quite large. On the right-hand side, you can see a much wider divergence across emerging markets. Some emerging markets have quite high household savings, others are moving in the other direction. But the bottom line here, again, is simply that at a global level, household savings are still high, and that's contributing to very robust consumption growth for many households in some of these economies. There was a nice article in the Financial Times today by Rana Farohar, who pointed out that in 2021, household consumption in the US was 9% higher than it was in 2019, so prior to the pandemic, and in 2022 it was 6% higher. So these numbers are really very large and they're driving ongoing spending developments. And then if you add to that the fact that across advanced economies and emerging markets, you're still running very large fiscal deficits. The graph on the right shows you fiscal balances as a percentage of GDP. The outcome is the tight labor market story that we also have heard that's feeding into core inflation. This is a graph just showing you the ratio of job vacancies to the unemployment rate. Again, quite wide divergences across different parts of the advanced economy world, but the US is the red line, and you can see that's exceedingly high still. The UK saw quite a big pickup in the number of job vacancies, whereas Germany, which is the blue line, has had a different kind of experience, in part because Germany's growth rate has declined. So what's that contributed to? Well, a late start certainly to monetary policy tightening, but eventually very sharp hikes. And you can see that on the far right-hand side of this chart, where we look at what happened through 2022, 2023, and into 2024, the way in which advanced economy central banks eventually tightened policy quite aggressively. So what else are they doing to try to rectify things? Well, in our view, central banks resolve has stiffened to deal with the inflation problem. There's much better communications about it, a kind of central banks, we're going to do what it takes to get inflation down message that is caught on and is being broadcast across these different economies. And you can see a perspective on this in the right-hand graph, where we're showing you median FOMC projections. So this is what the Federal Open Markets Committee said the interest rate will be at various points in time, and the way in which the market interpreted what was going on, which is that blue line. So that's what the market says the Fed funds rate will be. And you can see a big gap opens up. Let's see if my laser here works. In this area here. So what happens is the Fed starts to be more aggressive in its communications. I'm just using this as an example of what central banks did around the world. But they became more aggressive in their communications. But it took quite a while for the markets to catch up and to buy into what central banks were starting to say. Anyway, this becomes a sea change for monetary policy tightening over time. So policy now is better aligned to the inflation target challenge, or the inflation challenge that they have. This graph is showing you the difference between the real repo rate and the neutral real policy rate. So this is a measure of the extent to which central banks have tightened over and above the real neutral rates that they model and use for their policy setting. And you can see again across the advanced world in the blue and the emerging markets universe in the red, the way in which those policy rates have increased. Just for those of you who have trouble seeing this, because it is a little bit difficult, and I apologize, South Africa's here. So our real neutral rate, our real rate is just about roughly 1 percentage point above the warranted neutral rate. There are a few exceptions to this policy tightening, and one of the problems that that countries are having with getting inflation back to target, alongside the stickiness of services and labor market outcomes, is that fiscal positions remain deteriorated. So governments are continuing to spend quite a lot to try to push along their recoveries. These are government budget balances that are measured as the percentage points of GDP relative to their pre-COVID averages. So the numbers themselves in absolute terms are not huge, but you have to understand what you're actually looking at here. So I don't have an average number, but if you take, well, let's take, who should we take? Well, take South Africa, the blue, I guess, that's the easiest one to see there. You can see that our budget deficit is running at about 2.5 percentage points of GDP over and above what it was in the pre-COVID period. In other words, fiscal policy is still adding quite a lot of demand to all of these economies. One result is that global growth repeatedly surprises to the upside. So on balance between fiscal and monetary policy, policy is not as tight as our forecasters expect it to be. And the graph on the left shows you quite clearly how global growth forecasts have evolved over time. So that green line stepping up just shows the revisions upwards in global growth as time goes along. I won't go through the right-hand graph. So we've got a pickup in global growth. But it's also true that the growth distribution across countries and among its sources of growth are actually diverging. And we try to show this in this chart, these two charts. The graph on the left-hand side shows you what the initial US Q3 2023 forecast was, which is the red, and what the outcome was, which is in the blue. Much lower divergences, of course, across these other parts of the advanced economy spectrum, but certainly in the US, this is a big gap. And then on the right-hand side, what I'm showing you here is the breakdown of growth between services and manufacturing. And this has been going on for some time, but you can see the green line, which is manufacturing. You had a big ramp up as the pandemic unwound, and so there was a lot of consumption of manufactured goods, and trade came roaring back, and then that started to filter out, and then you started to see a shift in consumption away from manufacturing to services goods, and now services are driving or accounting for a larger portion of growth. There's greater divergence also amongst emerging markets, so it's not just between advanced economies, it's not just between sectors, it's also happening within the emerging market universe. And part of, I think, the right explanation here, it's a bit too early to pin all of these things down because of the difficulty of the analysis, but there's something here that has to do with the way in which different countries dealt with COVID, how much they were scarred by COVID, and then how much their growth rates are being shifted around by their policy decisions, as well as an increasing move towards a more fragmented global environment. Just some estimates of the costs of geofragmentation to growth rates in global economies around the world is provided on that right-hand graph. This is from an IMF working paper. And you can see these numbers really are quite large. Even for advanced economies, a breakdown of trade and finance would get you something like -2%, increasing to 2.5% for emerging economies, and then low-income economies would get hit very, very hard indeed by something like 4 percentage points of GDP. So let me move now to South Africa and start with a view of growth. I'm giving you a kind of long-term perspective here of real GDP on the left-hand side. It's always useful to kind of think about where we are now relative to going back quite some distance in time. This goes back to 2000. And what you can see is that green line in a quite linear way lowering, and you will know and remember that this was reflected in the way in which that we have generated changes in our potential growth estimates. And then on the right-hand side, I'm showing you the difference between the potential estimate that we have, which is the red line, and nominal GDP averages, which are the pre-COVID averages, that blue line on the left, to the left of the big spike, and then the post-COVID average is to the right. So the point here really is just simply that from a nominal demand perspective, broadly between the pre-COVID era and the post-COVID era, there's quite a bit of demand being pumped into the economy, but you've got a potential growth rate that is really quite weak. How does that look in our current forecasts? Well, you can see on the left-hand side, I've given you here the gross domestic product on a quarterly basis. Let me point this out here. So this is 2022 Q1, and then this one here is 2023 Q1, 2023 Q2, 2023 Q3, and Q4. These are our forecasts. The Reuters consensus and the Reserve Bank's consensus was that Q1 and Q2 were going to be very, very low. They actually surprised to the upside, and I'll show you why in a slide or two. Our Q3 and Q4 forecasts remain quite weak. If you look at the right-hand chart, you're seeing the GDP, which is in blue, and the potential GDP on an annual basis, and this is also our forecast. So you can see how our forecast measure of potential was incredibly low for 2023, but then bounces up quite a lot for 2023 and 2024, and then you get a continued pickup in demand up to around the 1% level. So these are not great growth rates, of course, but they're better than what we expected for this year. So what's going on here? Again, energy and logistics have set a constraint on the growth path of the economy. Many of you will have seen this chart on the left before. It just shows you cumulative load shedding by year, and this is 2023. So we're losing a lot of gigawatts of electricity supply to the economy in 2022, much more that was occurring in 2019, 2021, 2020, but 2023 really shot the lights out, to use a very bad phrase. On the right-hand side, I mean, the curiosity in a sense is that despite electricity produced falling, that's the black line or blue line, our logistic constraint has expressed as total cargo handled at South Africa's ports, that's the red line going down. We're still seeing a rise in real GDP, and that's the green line over time. Presumably that GDP line, of course, would be much stronger had these constraints not been binding. There is some adaptation going on. Industry is responding to the energy sector problems. Again, many of you will have seen these kinds of graphs. The left-hand side just shows you the nominated self-generation capacity registered with NERSA over time, and you can see in particular in 2023, Q1, a very large ramp up in the number of megawatts that are intended to be supplied by the private sector. And on the right-hand graph, you're seeing how this comes out in the gross fixed capital formation numbers, and you can see this kind of greenish column here is again a mirror image of what's happening here. It is a rise in gross fixed capital formation by the private sector, presumably in response to the energy constraints. So that's good news, clearly, that the economy and the private sector in particular are adapting. They're taking advantage of the liberalizations that have come on stream. There is some resilience in the demand side of the economy as well. That's why we get that growth rate and why we get that gross fixed capital formation upside surprises in Q1 and Q2. This graph just breaks that down by demand component. And what I just want to draw your attention to is that you've got net exports. Here are these red columns that are detracting from growth. I'll talk about those just now, but those are essentially the decline in commodity export prices, and so less value added coming from commodity exports combined with a rise in imports to both for consumption purposes and from gross fixed capital formation, and that generates a negative on the net export side. But you see household consumption is green. It is still positive in real terms. You've got government consumption is that yellow bit, and so it's also adding to growth. And then gray is that total investment line. Going forward, we think that demand is going to remain relatively muted, but on balance positive. The big negative shock to the terms of trade is happening now. Credit also continues to flow, with corporate credit extension really being the most modest. Part of the story there, I think, is just simply that during the pandemic, corporates took on a lot of debt. That's the green line going up. So this is real year-on-year credit extension. And you can see the way corporates kind of responded to the pandemic by ramping up their borrowing. Now it's coming down. And also less commercial property investment going on there. Households' credit extension continues to tick up in positive terms, and then the blue is government's overall borrowing, also rising pretty steadily. Now some of the challenges. So with fiscal extended and those commodity export prices weaker, we're moving towards a current account deficit. This graph just shows you on the left-hand side, this is this red line is the balance between the gap between these two. The green is total expenditure, as a percentage of GDP. The gray is total revenue, and that's your difference, which is the main budget balance, which has moved very steadily into a deficit position. We're still at quite a substantial deficit, so that's part of our investment savings imbalance. And then another part of what's emerging in the current account is this drop-off in commodity prices, which you can see very sharply here. If a lot of the movement in that green line is from PGMs, in particular rhodium, but also palladium, and you can see they're starting to come down and pulling down even that red line, which excludes PGM minerals. This is the current account deficit sliding into deficit. The right-hand graph shows you the current account balance in black, and superimposed on that is green, which is the terms of trade, which is just exports over imports. And you can see how closely correlated they are. On the demand side, the left-hand graph is trying to give you a perspective on that. And what I'm showing you here is just simply how, as the economy continues to tick over, gross fixed capital formation remains a bit more robust, you start to see an increase in the size of the manufacturing trade deficit. So we always run a deficit, as you can see, but you can see how this has actually increased quite a lot over the past year or so. And then you can also see how the mining surplus, which is the blue columns, has gone down fairly steadily over time, certainly not at the heights it was about 2 years ago, but it's contributing to lowering the trade surplus and generating more of a current account deficit. So why does this matter? Well, it matters because it impacts on our risk premium. That red line in the left-hand graph shows you how South Africa's risk premium has adjusted over time. You can basically think of this as the additional premium that residents, non-residents will want for investing in South Africa and solving South Africa's current account deficit or its investment saving imbalance, financing it. And you can see that that moves around quite a bit over time. The black line is the July MPC, the red is the September. It's basically following our forecast, but it remains at very high levels indeed. And that contributes in our modeling work for our forecast for the MPC into the real effective exchange rate and its degree of undervaluation, which is what I'm showing you on that right-hand chart. So if we have a high risk premium, we need to finance ourselves. What's the kind of one part of the solution to that is that the exchange rate depreciates. The other part of the solution to that is that we pay more for every rand of debt that we want to try to raise. I'm showing you here two graphs. One on the right, let's start on the right-hand side, shows you how the government's bond yield curve has changed over time. And the thing to take away from this simply is that very early in this year, which was the green line, January 2023, we were sitting at quite high interest rates, but they've steadily ticked up over the course of the year, and that's generated an increase in that risk premium, or helps to generate that increase in the risk premium I showed you on the previous slide. And then if you compare South Africa to the rest of the emerging market universe, which is what I'm doing on the left-hand chart, you can see again how our yield is quite high, whereas many other emerging markets have actually had a lowering of their yields, or those yields have actually stayed relatively well behaved. If I were to show you, I don't know if I have a slide on the exchange rate, comparative exchange rate slide, you'd see a similar kind of thing where the rand depreciates far more than other emerging markets. Now let me turn to inflation. This is a graph that we throw around a lot. It just shows you a very long-term view of what headline inflation looks like relative to real GDP. This goes back all the way to 1990 and makes the point that we make quite a lot, which is just that increases in inflation don't really do anything for real GDP growth. In fact, on balance, the correlation here is inverse. If we look at the more recent past, what we've been dealing with is the way in which different components of headline have moved around. So we've broken this down between core and non-core inflation. The headline rate is that red line, so relatively well behaved. You can see it goes above the target in the last year or so, peaks in June 2022, and then starts to come down. But of course, that red headline is made up of two very divergent underlying components, one being non-core inflation. So this is primarily energy prices and food, and then core inflation, which is kind of everything that is really determined or mostly determined, price determined in the domestic economy. And what we saw during the pandemic period, of course, was everything collapsed very nicely here, and that allowed us to cut interest rates very aggressively. And then as the pandemic unwound, we saw these incredibly strong spikes in things like food prices, energy prices, many manufactured goods, driven by supply shortages, driven by the demand expansion I showed you earlier, and pushing that up very aggressively. Meanwhile, the green line, we had core inflation, which is kind of, you can think of it as kind of wages and housing costs and services, that kind of thing, really very well behaved for much of this period, which we're thankful for, but our forecast always showed it ticking up, going back up to the kind of median area. So the big question for monetary policy for a long time has just been simply, well, how fast is this going to come down, and how fast is this going to come up? I've got here also our forecast going forward. It might be worth, I'm going to show you some slides on this just now, but this blue line ticks up in part because of the way in which this blue line is coming down so aggressively. You get what's called kind of statistical bounce in the numbers, and I'll show you a little bit more about that just now. So let's unpack core inflation a little bit more. Core inflation in this graph is that green line here. The blue is the services that I mentioned that have been quite well behaved, in part because of services price inflation, housing inflation, in part because of very muted wage growth. And then you see core goods inflation, which is pulling up that green line quite aggressively. So this is what we've seen happening over the past year, a continuous rise in core goods inflation, which has dragged up that green core inflation line. So what's happening in core goods? Well, this is where two quite different things meet: external factors and internal factors. The external factor is in part the exchange rate pass-through. So we've seen quite a lot of exchange rate depreciation over the past year in particular, and that's contributed to import prices in rand terms going up. And then on the left-hand graph, I'm showing you some large weight core goods components, in particular purchases of vehicles and alcoholic beverages and tobacco. And you can see here that not only is the implication being the consumption of these goods has gone up and their prices have gone up as spillovers have occurred. Purchase of vehicles, of course, is almost entirely an imported price. You can see that we have started to buy vehicles again. That's generating a price increase on top of the price increases that automobile manufacturers have wanted to price in after the pandemic. And then you add into that the exchange rate. And then you can also see the blue line, alcoholic beverages and tobacco, which is a component of the food, and the way in which consumption of that plus very strong food and alcoholic beverage prices have gone up and are feeding through into the core goods component. So you've got domestic components and external components meeting in that core goods inflation trajectory. As I've said a couple of times, services inflation has been better behaved. In the near term, we've had some good luck here. This graph is just showing you the way in which that services inflation line has moved between forecasts. In March, we had it pegged at the yellow rate. What turned out happening was the red, so we got a very nice drop down in services price inflation. We expect that to go back up, but on balance, we expect services price inflation to remain pretty well composed. So what's happening in that services price inflation? Well, the story is essentially that housing and transport have pulled down that services price inflation line, in particular in the last month or two. This graph is just showing you services price inflation overall in the black dotted line, and you can see the way it drops in the far right-hand side. If we exclude housing, that's what you get. You get a much higher services price inflation line, and then if you exclude transport and housing, you get a line that picks up even more, particularly at the far end. So housing and transport have been doing us some quite large favors in the last month or two. More broadly, services price inflation has also been helped, and core inflation again, by quite modest unit labor cost growth, coming despite the fact that inflation expectations have remained quite sticky. The left-hand graph just shows you how our forecast has changed over time for wages, which is the black line, and unit labor costs, which is the red line. So unit labor costs is just wages adjusted for productivity. And you can see here that in previous forecasts earlier in the year, we were getting these black and red lines, and what we've actually had is quite a big tailing off of these numbers. The forecast still goes up back to kind of a 4.5–5% median, but the fact that these are coming out lower has benefited the core inflation trajectory again. Now, the worrying point is that inflation expectations have been sticky. You need to think about inflation expectations being both backward-looking and forward-looking. They tend to tell us something about the future direction of wages, and we often tend to think that when there is very large food price shocks, that eventually they will find themselves, they'll find their way into wages. So while there's good news on the left-hand chart, the right-hand chart is a little bit more worrying, to say the least, and it's something the committee will watch very closely. So while we need to see what happens with core and see how it moves over time, a range of risks have emerged to the non-core component. So that very nice blue line I showed you a few slides back, coming down very, very nicely, is starting to be under a bit of threat again. And for those of you who read the MPC statement very carefully, you will notice that over the last few meetings, that statement has expressed additional and increasing concern about some of the numbers I'm going to show you here. On the left-hand side is just fuel inflation. We were expecting it to continue to drag down on inflation overall through much of 2023. That's actually reversing now with the red. It's going up, so oil prices, as you know, have risen, and we've had some currency depreciation, and that's generating quite a large revision up in our September fuel inflation forecast. And then on the right-hand side, we're showing you electricity prices, which we've also, which were stable for a long time in our forecast at quite high levels, so running between 10 and 14%, and now we're starting to expect them to err on the upside. We're also seeing El Nino resurface. The left-hand graph just shows you a kind of very long time frame of episodes of El Nino plus other kinds of anomalies and the way in which food prices have reacted to them. You can see there's a lot of volatility in the food price inflation outcomes. There are some things in here that are not necessarily El Nino related, There's a tropical cyclone here. There's the global financial crisis here. I can't even read that there. That's a flood. So this is when we had some floods here. So you're getting really responsive movements in food price inflation to different kinds of shocks. And the next shock coming our way appears to be El Nino. We haven't really factored it in here. It's coming in our forecast. But we've seen food prices inflation rising here anyway. It's just now starting to ease, which is a positive. But that easing we had expected to happen for quite some time, and it didn't. So food prices are extremely difficult to forecast in the environment we're in, and it doesn't look like they're going to get any easier. And that lends itself to upside risks. The graph on the right just shows you different components of the food price basket and the way in which they've moved around. I won't walk through all of those numbers. You can see the general trend. So what does our headline inflation forecast say now? Well, we still got headline sideways moving into 2024, so broadly kind of stable movement here, and then starting to fall as we get into the latter half of 2024 and into 2025 to right around the midpoint of the target. Last few slides. So what has the MPC done over time? Obviously, in this NPR review, we only raised the rates once, which was in May, by 50 basis points. That was the last increase. There was no change in July and September. The committee's view is that the stance is now restrictive, and you can see this very clearly here on the right-hand chart, where that green line is our estimate of the neutral real repo rate. If you remember a slide I showed much earlier, comparative slides showing a similar kind of thing, and now we get to a real repo rate that is just above that slide after obviously a very long extended spell of very negative real repo rates, well below the zero line, but also well below the neutral repo rate level that we estimate. And then if you look on the left-hand chart, I'm just showing you again what the policy stance looks like relative to inflation over a very long period of time, going back to 2000. Again, you can see extremely high volatility in the headline inflation. You can see in which the nominal repo rate responded to that. And then we've had a very nice prolonged period here of a lot more stability in both headline inflation and the nominal repo rate. This black line is actually the 4.5% line. It comes out black here for some reason, but dotted there, sort of to avoid any confusion. Again, you can see a couple of things here. I mean, one is just simply that headline inflation, even in this more stable period post the GFC, was still running at about 6%. And those of you who listen carefully to what we say over time will know that we started talking about the 4.5% midpoint of the target range to try to get away from this 6% level, and that duly occurred, and it allowed that green nominal repo rate to come down. And then, of course, when the pandemic hit, we cut very aggressively to reflect the fact that we thought inflation was falling sharply. And now we're back up again to respond to this inflation shock. So, last slide, just takeaway points again. Globally, and I think for South Africa as well to some extent, although less so, policy targets remain elusive. Inflation looks quite persistent. Advanced economy rates are likely to be high for long. The big question out there, I suppose, for the markets in particular is whether that's higher for longer. There's more variation in the emerging market space, but there's a lot of uncertainty about global neutral rates. So part of the answer to this higher for longer question is whether or not global neutral rates need to rise. And of course, there's a lot of work being done in central banks and by academics to estimate that. Certainly, what's clear for emerging markets is that at the rates we're at now, and definitely if they go higher, there's quite a lot of caution has to be applied by how we run policy, because financing risks are going to be much more acute. The risk universe, as I've tried to show, has expanded quite a lot, both in the near and the long term. Some of the underlying structural drivers of that expanded risk universe have to do with increasing concerns about geopolitical fragmentation, trade, finance in particular, the way in which climate shocks are hitting all of our economies increasingly, the kinds of costs that those generate, and the way in which they feed through into prices, in particular food and energy. And then finally, a rather cryptic reference here about regime shift. And the issue here is that one of the things that we've seen is the way in which price and wage and external shock dynamics for a long time over the last 10 years were generating lower inflation outcomes, and now we're seeing them reverse. So the linkages between these different prices generate rather suddenly a shift from a low inflation dynamic to a high inflation dynamic, and that's work that's being done or has been done by the Bank for International Settlements. I strongly encourage you to read it. It's very good. There is some resilience and growth, both globally and in South Africa. Surely more investment will be better for inflation outcomes. Part of what we want to see is that potential growth rate that I showed you in many of the slides, especially for South Africa being so low. We want those to actually go up to get better growth rates. More productivity, more investment is also good for inflation outcomes. And of course, monetary policy will remain focused on making sure that the inflation outcomes are anchored and the risks are adequately catered for. Thank you very much.
You can see it, Chris, you have been running twin deficits. Okay, we are now at that point where we are going to invite questions and comments. Compliments to the presenters are also welcome. Just to be clear, you have got the MPC here in full, Rashad Kasim, Kuben Naidu, Fundicha Sivana, the deputy governors, and Chris Lovald, who is the head of research in the bank. Any early takers? Thank you. Azar, and then behind him.
Azar Jamini, Econometrics. Governor, two questions, they are related. The one is, no mention was made of the fact that fuel prices could come tumbling down next month, despite the increase in oil prices that we have seen. And given that the Reserve Bank's own research has shown that food price movements have a big impact on food price movements, is that not a very positive potential development for the inflation outlook domestically? Secondly, having been at Marrakesh, what is the view in terms of the potential impact of the geopolitical turmoil in the Middle East on monetary policy reaction? Is it a case of, even though oil prices have risen and might rise further and inflation increases, will central banks possibly adopt a more lenient approach due to the fear that the impact of the turmoil might around the corner beyond this initial rise in oil prices may actually have a more detrimental effect on economic growth and demand, which may cause inflation to fall faster? What was the view? Are we heading for more lenient monetary policy as a consequence of this Middle Eastern turmoil?
Thank you, Governor. My name is Yanni Rousseau. Governor, the Reserve Bank published in August 2023, as part of its special occasional bulletin of economic notes, a research paper with the title Review of Administered Prices in South Africa, the Petrol Price. This was written by Shakira Ishmael and Christopher Wood. And amongst others, this research paper assesses the cost of fuel as an important driver of inflation. The paper states on page 8 that the retail margin has consistently been the most significant driver of fuel price inflation outside the basic fuel price and levies. And the paper then assesses the composition of the retail margin in considerable detail. However, the research paper does not point out that fuel retailers have to pay from this retail margin a high fee on credit card transactions when fuel is sold. And this high fee goes to the financial services industry. Currently, retailers pay the financial services industry nearly 45 cents per liter of petrol sold by, or diesel for that matter, sold by means of credit card. So this nearly 45 cents per liter amounts to about 22 rands 50 per 50 liters of petrol sold in this way. So my question then is, can the Reserve Bank not take steps to lower this margin of 45 cents per liter paid by the fuel retailers to the financial services industry in a quest to contain increases in the price of petrol and therefore in inflation? Thank you.
Thank you, the Governor. My name is Rosani Munyai. I'm coming from SARS. So my question is relating to what Chris mentioned in one of the slides where he talked about the impact of load shedding in the economy. And now I just want to find out from the Reserve Bank, what's your position in terms of what other people are saying, to say maybe it's time we privatize ESCOM. Do you think, is it a good idea? What's your position on that? Should we privatize ESCOM or should we keep on bailing out ESCOM? Thank you.
Okay. Let's take one last one in this round. Okay, it looks like Yanni had scared everybody. As our fuel prices tumbling, I'm sure they are coming down. I'm not sure that they are tumbling. But we can't make policy on the basis of a reading of one month. Obviously, a decline in fuel prices will be a welcome relief. When we do the forecast for the November MPC, which will be in a few weeks' time, we will have that as a starting point already. So that will help. The geopolitics impact on monetary policy, that was the thing. The IMF couldn't even arrive at a communique. When the IMFC meets, we release a communique and we say, this is the state of the global economy, and so forth and so forth and so forth. The reason why we couldn't release a communique was precisely because we couldn't agree on the geopolitics. So I'm afraid I'm not going to help you. I am coming out of there no wiser. All that everybody agrees is that it has added to the uncertainty. But there is no agreement in terms of where this thing is going. Yanni, the stuff on the Oban, I hope you read Oban is the occasional bulletin on economic notes. I hope you do read the disclaimer that all the papers are in there are the responsibilities of the authors, and they are not the views of the bank. So I am quite happy to put you in contact with the author so that you can engage with the author on those things. But you do raise an important point about the fee that is charged by the credit card companies. I do not even know if they all charge the same. They can't. They would not, because there are 3 card schemes here that in operation, and it would be very questionable if the 3 card schemes have exactly the same fee. But someone will help here. I am not even sure that you have worked this thing and says 45 cents per liter. I don't think that they can charge per liter. They charge per amount of transactions, and I think that it is staggered, and somebody can always get into that. But the Reserve Bank does not control banking fees or banking charges. Those are set by the individual institutions, and it is important that those institutions get engaged in competitive behavior. And so the Reserve Bank does not get into the setting of fees. But I have got the CEO of the Prudential Authority here and a former one. So they would probably like to comment on that. Load shedding, yes, the cost of load shedding, yes, that is what we have. The Reserve Bank's position on privatization or otherwise, our views on this do not matter, because whatever our views are, they are views, they are just that. It is for government to make a decision on whether the government privatizes, nationalizes, partly privatizes, concession. It is not for us. Our responsibility is price stability, and that is what we focus on. Panelists, anybody want to add anything on the credit card story? Naidu?
Thank you, Chair. You 99.9% correct. Most of the fees in that credit card or debit card companies charge the consumer are set by the market. There are some fees that are set by the central bank, some interchange fees. I'll give you 2 examples. So if you go to an ATM that is not your bank ATM, we set the fee that the banks are allowed to charge each other for that. If you go to a retailer and you draw cash at the point of sale, we set the interchange fee. But there are many, many bank charges on top of the interchange fees. I'll give you a small example. A pay-shop transaction, the interchange fee is 10 cents. A bank could charge R2.50 on top of that, right? And that, in some ways, a market-determined rate. So there are some prices in between credit, debit card, and in the payment space that we do set, but the bulk of the price setting is a market-based mechanism. Thanks, Chair.
Thank you. Next round of questions. Andrea. If you stand up, you might just appear on TV.
Thank you, Governor, and to the broader committee. It's Andrea Macia from RMB Morgan Stanley. So I have 2 questions. The first one is, you showed a very nice chart, Chris, on the declining trajectory for the risk premium in the forecast. So I'd just like to get an understanding of what is behind that expectation of falling risk premium. And then secondly, is how comfortable are you with your assessment of R-star trending higher over time? I would imagine that a large chunk of that is driven by the improvement in potential growth that you're showing. But you've also got this declining risk premium. So how do you how sure are you of that? Because that clearly will have an implication for the higher for longer stance of monetary policy. Thank you.
Chris Lovald, it looks like those questions are directed at you, my friend. Can we take some more? I was just prompting Chris so that he can check his notes.
Thank you, Governor. We have two questions online on YouTube. They're both from Helmo Prius. The first is, do you have scenarios for several post-election options, or is your forecast a continuation of the ANC government?
I'm struggling to hear.
Can you hear me now? Helmo Prius asked, do you have scenarios for several post-election options, or is your forecast a continuation of the ANC government? His second question is, do you expect more fragmentation in South Africa as people migrate to areas where service delivery is efficient and industries go off-grid to avoid Eskom load shedding?
I don't know if somebody can switch off this speaker. It's creating hell. I'm struggling to hear. Further questions?
Thank you, Governor. It's Danielle Masia, Deutsche Bank. So we are able to now assess the impact of global monetary policy tightening up to now, at least how efficient are transmission mechanisms. In some of the presentation slides today, we can see that the US is clearly not quite responding as much as other countries to tighter monetary policy. They've obviously also had larger fiscal stimulus, as you've rightly pointed out. Do the Fed, at least the next steps that the Fed may be taking, does it now matter as much as what it did before? Because I can imagine that many other economies, UK, Europe, are starting to actually show the impact of tighter monetary policy on their economies, which raises downside risks to global growth next year. So maybe the benchmark that the market is worried about, which is the Fed pricing, is not the right benchmark.
The question is?
Does the Fed's policy rate move in terms of them potentially hiking again, given the strength of their economy? Does it matter as much as it did before? Because I would imagine that perhaps their transmission mechanism is weaker than in other developed economies.
Fundi, I mean, this question, you like answering this question, so since you like it so much, I'm going to give it to you again. Okay.
Oh, thank you. Governor Mzovu Nyamela here from Montenova. I think the story about interest rates higher for longer is quite clear, especially if you look at how equity markets have performed over the past 2 months, even to a certain extent, our local bond markets. However, if you look at forward rate agreements, so the 3 months forward rate agreements in different periods, what you see is that generally the market is expecting interest rates to likely come down in the next 6 to 7 months. Do you think that is pessimistic or optimistic? I'd like to hear your view on that. Thanks.
Yes.
Governor Nompumelelo Siziba from SABC.
You don't want to appear on TV. If you stand, you will appear on TV.
I'm on TV all the time, so. Good afternoon, Governor, and the rest of the team there. I just wanted to ask, so we've been hearing from the Electricity Minister that there's more capacity that's come on stream through the Kusile units coming back earlier than expected. Of course, we're heading towards the end of the year, and in the next couple of months, things are going to slow down. But is there then going to be a more optimistic outlook from the Reserve Bank in terms of what that does for economic growth? Because you guys have said that you expect economic growth to be wiped out by 2 percentage points because of load shedding. And the Electricity Minister is telling us that there's going to be less load shedding because of this additional capacity. And of course, we do have additional capacity coming on from the renewable energy side as well. So is this going to change your outlook in terms of economic growth because we should have more capacity?
Okay, thank you. Chris, shoot off with your risk premium and the Andreas question.
Do you want me to handle the last one as well? Or are you okay with that one?
You want to handle the last one as well? Yeah, you can handle it.
Okay, all right.
Yeah.
So, Andrea always asks this question, and it's always a very difficult question, because these are estimated variables by and large, and so a lot of judgment has to go into them, as you know. The risk premium, I think we felt that it hit a height at the time of the announcement of the pandemic, and I think that makes sense. Where there's a large global shock, the risk premium sort of peaks. There were some other things going on in the economy at the same time, including a credit rating downgrade. So I think it's right, if you look historically at the movement in the risk premium, that it peaked at that time and then has steadily declined with quite a bit of volatility, because of course there have been other shocks. But the risk premium is really something that comes from the market. It's what we derive from the market and what the market tells us. In terms of the forecast for the risk premium, it should come down if you assume that there aren't going to be a lot more large negative shocks happening, because GDP should be rising. The fiscal position is going to do what the Treasury expects it to do, so it will require less financing over time. And so those kinds of numbers, those announcements get built into our forward-looking view of what the risk premium should do. It's not to say there won't be other shocks that will move it around. They will be, but we don't know now quite what those are going to be, right? On the R-star, how comfortable are we that we're pushing it up? I would say pretty comfortable. Again, a lot of this depends on what happens to the R-star for the rest of the world and the way in which that moves up. Our movement that we've done so far up to now has been very marginal, actually. It's been really by 0.1s and 0.2s, 0.3s. So I don't think that we are going out on a limb by moving it up. Part of that global R-star story is about this issue in the G3. So the thing I referenced a couple of times in the presentation about higher for longer, and the way in which markets and central banks are trying to understand global neutral real rates, and I think the direction there is quite clearly upward, but the magnitudes we're not very clear about. If our terms of trade continues to weaken, or even if it stabilizes, if our GDP goes up, then we will have a current account deficit that is something like 2-3% of GDP, and that's going to require financing. That lends itself to a higher R-star. And then the potential growth rate is, probably the most difficult of all. There are two ways of thinking about this. One is that in an economy that needs a lot of productivity and investment, which is shown by the low potential growth, you need more savings to finance it, and that would push up your R-star also. The alternative way of looking at it is what comes out of some of the American literature, which is to say, well, when potential growth is very low, that drags down the R-star. I don't think anybody knows, to be honest. But the point is, you need to kind of think about both ways of looking at it and figure out kind of how it impacts on your own estimate. I don't think that last element has any particularly large impact on the way in which our R-star estimate has increased over the last 6 months or so. Just on the electricity capacity story, our forecast for the way in which load shedding impacts on growth has changed quite a lot. We did think it would take off 2%. Our more recent estimate is something like 1.8%. That's driven by less load shedding, but more days of load shedding. So we revised up the number of days of load shedding for this year, but we reduced the number of stages. And then for lower levels of load shedding, we zeroed out the cost. So there's no deduction when you have load shedding of stages 1 and 2. So our forecast is building in this adaptation that we think households and firms are undergoing. So, as we go along forecast to forecast, we are going to build in the latest available data that we have. It is a little bit difficult now for us to take announcements by NERSA or anybody else and say, well, those headline numbers are going to come on stream as additional energy supply on day 10 of month X, right? We don't know how to do that. And so what my team spends a lot of time doing is talking to the different role players and understanding how that's likely to work itself out. And then, of course, we will be revising our growth estimates as we go along. Just one final point on this. I mean, there is a very large difference in the load shedding assumptions we make for 2023 versus 2024 and 2025. For 2024 and 2025, we move from 0 in 2023, that was our initial estimate early this year. We went to 1% for next year and just over 1% for 2025. Now 1% is not a big number, but the movement is very large. And our load shedding number of days and the deduction are much, much smaller for 2024 and 2025. So as we get more information, we will adjust those estimates as we go along. Thank you.
Okay, Fundi is going to come with the first thing. Rashad, I want you to deal with the higher for long or longer, high or higher for longer or long, since that was what was being discussed in Morocco. And the gentleman is so excited about the FRAs. So if you can deal with the FRAs. And then Fundi, before you come onto the thing, it was said that the stars are not very useful to communicate. For those of you in the room, Chris and Andrea have been talking about R-star. And you must be wondering, where are these stars? It is simply that level of interest rates beyond which, if we are above it, we will know that monetary policy is restrictive. And if we are below it, we know that monetary policy is loose. Put simply, it is that interest rate where monetary policy is neither stimulatory or contractionary. But they like complicating things. They call it R-star. Fundi?
Thank you, Governor. So, Dudley, I wish you had added what was discussed in Marrakesh, then I would have escaped. So let me give this a stab, but I'll ask the Governor or Rashad to add at the tail end, because I'm certain this was a big part of that conversation. So I think that, the central banks generally are in a different period right now, because there are some structural shifts and movements that are happening. So I'll use that as a precursor. So if one looks at what is happening in the US market, the Fed has been reacting to what inflation is doing. But we know that there are other drivers in the economy. So if one follows what is happening to recent job numbers, they are signaling that the US economy is certainly a lot more resilient than what is expected. So I certainly think that the Fed has its work cut out for it. And I'm going to highlight potentially 3 areas where this is going to be material going forward. The first is in a post-normalization period for the US, there was always going to be this big test in the post-QE world, post-quantitative easing, in terms of whether we can get full normalization where the Fed hikes up interest rates and you get the market operating under this new regime where there is no more quantitative easing, and what would the impacts be. So I think that it is material in terms of the Fed signaling that it is able to achieve its own target. So I think that that part is material. The second part of materiality is what does it mean for financial conditions in general? So if the economy is not cooling down, and inflation is still not moderating to the extent that the Fed would like to, I think that the jury is still out in terms of whether the Fed sticks to its previously communicated trajectory, and that does have impacts on financial conditions in general. It does have implications for certainty in the market. And for all of us that are in the emerging market space, we do know that volatility does have significant implications and impacts for us. We are seeing, of course, a number of other dynamics that are interacting with what is happening in the US market and the Fed's own reaction. So the one is the size of government debt that is growing in the US. So we can't just look at the Fed's reaction function in one direction. There are multiple things that are happening there that would add and contribute to market uncertainty and volatility, which would have an impact. The other issue, of course, is the broader impact in terms of interest rate differentials across jurisdictions, and also what happens to currency markets. So, Donnelly, I think this is my long way of saying that, none of us know with certainty what is going to drive the Fed's reaction function going forward, because they have been doing the best that they can, and they have signaled to us that they would like to see the economy cool down. If the economy continues to be resilient and inflation doesn't come down, I think the levels of uncertainty will continue to increase. Now, for us as the SARB, you'll recall that part of one of the things that we would look at in determining what is our neutral interest rate is what is happening to interest rate in the large economies, and also what is happening to our country risk premium. So for us, that does have a material impact over time in terms of what happens to our own interest rates in country as well, and also what happens to the currency. That's my long-winded answer. Those who are in Marrakesh might have smart answers. They might have heard from the Fed directly.
The short answer would have been, the Fed is communicating very well, and we don't understand why you guys are confused about what the Fed is saying. Rashad?
Yeah, just to say that when we talk for higher for longer, there are patterns in the global economy. In the case of the developed countries, there's some concern about the persistence of tight labor markets. There's confusion in some cases about why the labor market's so tight. It has to do with change of demographics, people withdrawing from the labor market. In the emerging markets, the higher for longer is a concern that exchange rate pass-through is not what it used to be. As you saw from one of Chris's slides, there's renewed worry about the oil price. There's renewed worry about the persistence of food prices. And that the higher for longer, higher interest rates in the advanced countries remain a constraint to some extent, to the extent that capital flows will continue to be a challenge for emerging markets, and that's a big issue, putting pressure on emerging market exchange rate and what that means for inflation. What the FR says about South Africa, is that there's the FRAs, there's inflation expectations. I think that, every time numbers come out, they look better than expected. Then we see some signaling about cuts. When the numbers get reversed, there's a whole different story. We can't say with confidence when we're going to put cutting in our cycle. The textbook is we're data dependent. If there is, once we get through a downward movement from the peak in a more sustained way, then I'm sure that that will emerge in the discussions. Thank you.
Thank you very much. I guess you watch the FRAs all the time. I don't watch them all the time, I watch them sometimes, but I especially ignore them a week before the MPC because they jump all over and they are not a very useful signal of where interest rates are going. If you want to know where interest rates are going, watch the MPC press conference. That is a more reliable indicator than the FRAs. And then there was a question about some political scenarios. I wish there were political analysts working in the Reserve Bank. Unfortunately, there aren't, so we do not have any political scenarios for you. The thing about political scenarios is that there isn't a shortage of commentators in the South African space. You can just call on radio and call yourself a political analyst and you can offer scenarios. Unfortunately, the trade that we ply is economics and is driven by numbers. And that's what we do. We beat these numbers until they confess. And I think that they did confess today. They told a story. I'm told there are no more questions online. For those of you in the room, you might have realized from Chris's presentation that monetary policy is just slightly restrictive now. We are into restrictive territory. But there isn't a shortage of liquidity. So there will be some liquidity at the end of this session. So continue the networking and you could ask MPC members questions during that session. Thank you very much for your attendance, and for those online, thank you very much for tuning in.